Hello and welcome to eOption's webinar, and we're excited to have you here, and thank you for taking the time out of your day to join us. We partnered today with the Options Industry Council, or OIC, today to bring you this webinar on understanding the Greeks, or it's all Greek to me, using Theta, Vega, and Rho. My name is Gina Bocaius, and I'm with eOption. And just to give you some logistics on how this session will work today, the session will last approximately 45 minutes. The speaker will talk for 45 minutes, and then he'll answer questions at the end for about 10 or 15 minutes. If you have any questions at all during the presentation, you'll see a Q&A box on your screen, and feel free to go in there and type in your question. Our speaker, Ed, will see those questions, and he will do his best to answer as many as he can at the end of his presentation. Now, you'll also see a chat box. We ask that you not put your questions in the chat box, just the Q&A box, as the speaker won't see them, and we want to make sure we get all of your questions answered. After the presentation today, if you have any other questions, or if you have specific questions about trading strategies or using our platform or any of our services, you can always reach out to our trade desk at any time. And we know many of you currently have accounts with eOption, but for those of you who aren't familiar with us or are currently trading with us, just to tell you a little bit about us, we do cater to option and stock traders, thus our name eOption. We pride ourselves on our commissions. Our stocks and ETFs are just zero commissions, and options are just 10 cents per trade plus a base of $1.99 per trade. So you'll see it's one of the lowest in the industry to trade options. Our firm was started by an expert options trader. He was one of the founding members of the Chicago Board Options Exchange in the 70s, and he's a tremendous option and stock trader, and created his ideal trading company for sophisticated traders. We do also offer other tools such as Options Play to help you set up specific option strategies. And we do have education on our website, including webinars, videos, and we also have a whole page on strategies from the Option Industry Council where you can just click and learn about a specific strategy. So without further ado, we'll get started. For those just joining, we'd like to welcome you to our webinar on It's All Greek to Me, or Understanding the Greeks, Theta, Vega, and Rho. And I'd like to turn our attention to our speaker now, Ed Madla from the Options Industry Council. Ed has over 20 years of experience in the financial industry. He started his career with Hull Trading Company, where he was an options market maker at the Chicago Board Options Exchange and the Chicago Mercantile Exchange. He then spent many years as an independent trader of stocks, options, and futures. He then went to MF Global and went on into the futures brokerage business, and then joined RJ O'Brien. In 2014, he joined the Options Industry Council, or OIC, where he is today. He's currently the Director of Business Development at OIC, where he oversees retail education programs. He also has a lead position in the production of options curriculum for the OIC. And we've had Ed do some of our sessions in the past, and we're excited to have him back today. So without further ado, I'll turn it over to Ed. Thank you.
Thank you very much, Gina. I always enjoy doing these sessions with eOption. As you said, my career's taken a few different paths, but for the last 5.5 years, this is all I've been doing, teaching options to investors and money managers who either want to be introduced to the product or to gain a further deeper level of knowledge on the product and use options wisely. Today's focus is going to be the Greeks, and I thought it was a good idea to split this discussion into 2 parts. So instead of getting all of the Greeks in one session and maybe trying to fit in a little bit too much, today will be Greeks Part 1, focus on Theta, Vega, Rho. That's mostly going to be Theta and Vega, with Rho being a small piece at the end. And then the Greeks Part 2 is going to come up a little more than a month from now on Tuesday, August 25th, with a focus on Delta and Gamma. So today, just focusing on these 3. And there should be something in here for everyone, whether you're new to the concept of Greeks and you're just looking for definitions and basic level foundation. We've got that. I'll also offer some commentary and deeper analysis along the way for those of you who already have some familiarity. Here's our disclaimer. Options aren't suitable for everyone. They are a rather complex tool that needs to be deeply understood before using them in a live account. And I want to start today just looking at volume, considering what kind of year we've had in 2020. When you see 2018 and 2019 with the number of contracts here in the billions, this 5 billion number comes out to around 19.8 contracts traded per day on an average day. That gets this record-setting number here that we've seen last couple of years sort of fluctuate around. 2020, right now, more than halfway through the year, we're averaging 28.4 million contracts every single day. When you average out, where's 2020 going to sit? Well, the pace we're on is right around 7 billion, actually just over 7 billion contracts this year. That's how frequent and how often investors and money managers are turning to options during this year when we've seen so much market volatility for a variety of reasons. We all know what's going on with the virus, with political unrest, anything on a macroeconomic level. By the way, we've got a presidential election coming up. So all of this is going on, and the options product has seen a tremendous amount of volume. It may slow down, it may speed up, but the pace of 7 billion is pretty remarkable to see. Here's the outline on the Greeks. I'll start with just a few words as an overview on the Greeks, and then get into Theta and Vega. That's where I'll spend most of my time here. The rate of decay, long-term versus short-term. Vega, we'll have examples. Of course, you can't talk Vega without getting into historic and implied volatility. I'll have an example of Vega before and after earnings with some insight there that hopefully you'll find interesting. Then I'll close it up with Rho, really just a definition here of what Rho is, where it's greatest and least, and why it's important, although you likely won't focus on it with your everyday trading decisions. This is the list of the Greeks that I'll cover between today's session and on August 25th, the first order Greeks, Delta, Gamma, Theta, Vega, Rho. Now this says first order. These are the most well-known and the most predominant Greeks that you'll see, but there are second order Greeks and third order Greeks as well that might be for anyone who's looking for much deeper insight into how Greeks affect each other. There's all sorts of more complex Greeks that exist, a lot of which I've never heard of. In fact, wasn't too long ago, someone from the OCC risk pricing and margins team had reached out to me asking for help understanding some of these third order Greeks, and they had a list of them, and I didn't know what they were. And I certainly said, well, I can help you, but I do need to look these up to find out what they are. There's a lot of analysis that you can do. We'll focus on the first order Greeks here today. Now, what are the Greeks? Well, think about pricing models and where a theoretical value for an option comes from. There's all sorts of inputs that go into any pricing model: the stock price, the strike price, days to expiration, an implied volatility assumption, dividends, interest. Those inputs go in, and the output is the options price. Greeks are an attempt to measure or predict how much of an impact does any one of those variables have on the options price. If you change the stock price or the days to expiration or the implied volatility assumption or the interest rate, if you change any one of those, the options price is going to change. And the Greeks help interpret how much of a change might there be when any one of these variables in the formula changes. Altogether, they are looked at as the Greeks, and they measure price sensitivities by isolating each one of those variables. It's important to say right away that the Greeks assume all else remains constant, which of course is never the case. Things are never remaining constant or all else equal. But that's the math behind what the Greeks are attempting to accomplish. We're going to start with Theta. As I said, definition and some analysis and rate of decay. Where is it greatest? Where is it the least? First of all, what is the definition of Theta? Most of you who trade options likely already know. Theta is an options value's sensitivity to time. It is how much in dollar amount, how much will an option decay with the passage of 1 day? It's expressed as a dollar amount. You see it on your trading platform. That is a dollar amount number. How much is the option expected to decay from 1 calendar day to the next? It's important to note, calendar day, not trading day. It is true that over weekends, 3 days of decay comes out of the options price. That is true. And I want to expand on that for anyone who might be thinking, well, they can sell options on Friday and get 3 days of decay come Monday morning. Well, that might very well be true, and it might work out for you, but it doesn't. That approach doesn't come without risks. If you do sell on Friday, you are taking 3 days of risk where anything can happen in the world from an economic perspective, a military perspective, and we're now talking virus, political unrest. Anything can happen over those 3 days that move the markets come Monday morning. It is not uncommon to see big moves on Monday mornings when we do have market corrections in one way or the other. So you are taking 3 days of risk if you sell on Friday. One other detail here, this discussion always reminds me and reflects back on the late 90s when I was on the trading floor. We did see some order flow. I was in the pits as a market maker, and the customer order flow would come into the pits, and it was my job to make a market, a bid and an offer to each of those orders that came in. I didn't know what direction they were on. I was there to supply liquidity to the market. Well, on Fridays, sometimes you did see the order flow lean towards the sell side. And if the markets were quiet, there really wasn't too much perceived risk out there. I didn't want to be buying options all day on Friday, just like no one else did. So I would tick down the days to expiration, maybe late Friday morning, early Friday afternoon. I would change the days to expiration in my pricing models to reflect Monday morning's days till expiration. So by midday on Friday, I might be making markets off of a theoretical value that is reflective of 3 days less than Friday, just because I was forecasting out what that option might be worth Monday morning. That's how I did it, and that's how a lot of trading firms handled that situation every week, especially when you had a holiday weekend coming up. So just be careful if you have that approach to thinking you're going to get a quick 3 days of decay on Friday. It's not so easy. It doesn't always happen that way. Calls and puts both have negative theta amounts. That means they decay from one day to the next. Their values move lower. So generally speaking, if you buy options, you have negative theta, or theta is working against you. And when you sell options, you have positive theta. When you sell options, that's what you're trying to capture, is the theta and the decay of those options from one day to the next. Let's look at an example. This will be super easy, just very elementary arithmetic. An option's trading at 350 today. You have a theta of 3 cents. The contract is worth, this is the aggregate value, 350 times 100 shares, $350. 1 day later, you would expect the option to be worth 347. All else equal, seeing the theta of 3, this just shows you it's simple math and it's monetary. And if you were to extrapolate out 10 days from now, using a theta of 3 cents, just multiply it by 10 and you have your expected value of 320. And I can tell you right now, this number is going to be wrong. The 10-day forecast is going to be inaccurate, because not only are other factors going to change, theta itself is going to change every day over the course of the next 10 days. But it's what you have to work with today. You can tweak that number a bit because you know it's going to change. But the highlight here is that simple arithmetic, and you see the numbers, again, assuming all other pricing factors remain constant, which you would not expect to ever be the case, as the other pricing factors are always changing. Let's look at the rate of decay. This is a common topic, and we'll spend some time here for in-the-money options, which have very little time value or extrinsic value. In-the-money options tend to have this linear rate of decay as they slowly approach their level of parity. Don't worry about that term if you're not familiar with it, but in the money options just have smaller amounts of time value and have a more slow linear decay. at the money options, and this is options with a strike price that is close to where the stock is currently trading. At the money is somewhat of a gray, vague term. They're close to where the stock is currently trading. They do not decay in a linear fashion. There is an exponential rate of decay here that begins right around this 40-day level. That's where this arrow is pointing at, right around 40 days. You may hear different options traders say 35 or 42 or 45. Just roughly 40 days, you start to see this tipping point of where the rate of decay begins to increase, and then the rate of decay continues to increase all the way through expiration. The fastest rate of decay is going to be the last week and the last day of expiration. The tricky point when you're selling options is to try and accomplish an accelerated rate, a favorable rate of decay, but to sell an option for a value that is worth taking on those risks or worth taking on those obligations. At some point, even though on expiration day you're going to get 100% a depreciation of time value, it's not worth selling options that are trading at very, very low levels, even with that fast decay. So you have to find that sweet spot for you, and it might be different for each investor. It might be different from one stock to the next. More volatile stocks will see higher premiums at shorter expiration dates than less volatile stocks will. So variation there between your risk tolerance and the stock you're looking at. You want to find that sweet spot. Now, a little bit more I want to say about this idea of cheap options not being sold. As I said, you might be sitting there on expiration day and you see an option that's trading for 20 cents. It's out of the money. Well, you know that if the stock doesn't change, it's going to be zero at the end of the day. That's 100% decay. But is it worth selling an option for 20 cents? Is it even worth your time to take on those obligations and that risk? Oftentimes for investors and for money managers, when options reach a very low premium level, it isn't worth the risk, despite the acceleration of decay increasing. And I'm gonna specify here put options. Out of the money put options. Let's just say, for example, you're looking at a stock and the out of the money puts start trading. At some point, the strike prices go down to, say, a nickel bid with a 15-cent offer. Midpoint's a dime, and maybe theoretical values are generating option values for those options at around 8, 9, 10 cents. Well, if money managers and investors aren't selling those options because it's just not worth the premium, and buyers are willing to pay a nickel because that reduces their cost of capital, that can improve their margin situation, and even if there's very little time left to expiration, paying a nickel for protection might be worth it. So that nickel bid stays there. From one date to the next, as you have 10 days till expiration, 9, 8, 7, it's still a nickel bid. It's still offered at 15 cents. What I'm trying to say here is that it is not uncommon for certain situations, and I'm specifying out of the money put options as you approach expiration, for Theta to be wrong, to not be correct. And the forecast that Theta is suggesting doesn't actually come to fruition. When that happens, I'm tying this in a little bit with volatility. Thinking back to the pricing models, as I said in the beginning, you've got stock price, strike price, implied vol, days to expiration, interest rates. If the days to expiration are decreasing and the option value is constant, it's not changing, the only way to make that math work is to increase implied volatility levels. That's the way you have to do it. That's the only way the pricing models are going to accurately reflect an option value that isn't decaying. And you might notice this dynamic on a regular basis. As you approach expiration, the out of the money put options have an implied vol level that keeps going up, and that curve of implied volatility might continue to get steeper. You can plot implied vol at each strike price. That curve may continue to get steeper as expiration approaches because no one is selling those options worth a nickel or a dime or 20 cents. One example of when Theta might be wrong. There are some firms in the past that have made headlines because they look to sell expensive options. And it's often to find those expensive options in terms of I-vol in the puts, in out of the money puts. From one day to the next, they may look more and more expensive. But you have to understand why that's happening and why it really might not be worth selling options at those low levels, no matter what their implied vol is. Implied vol may not be going up because prices are going up. It might just be that theta isn't occurring as it is suggested that it would. One other thing about time decay, and I'm going to put up a short little knowledge check here in a second to give some simple questions out to you, test your knowledge. I often get asked, when does the decay occur? I see this number on my screen. I know it's per calendar day, but when does theta come out of an option? Is it midnight? Is it the closing bell? Is it the opening bell the next day? When does this number come out? It's a great question. And my answer to that is that theta is really constant. It's real time. It's always happening. And the best example of this is expiration day. If you have an at-the-money option that's trading for 50 cents at the opening bell on expiration day, and the stock does not move all day long, by the closing bell, that 50 cents has decayed down to zero. That option decayed throughout the trading day, hour by hour, minute by minute, it decayed. Theta is constant. It's always coming out of the options contract. However, when you look out weeks or months, or if you're trading leaps, that hour by hour decay is so minute that it's not worth considering. So you can look at the day-to-day value of theta, and that's enough. But do know that there is these very small fractional amounts that are coming out in a real-time basis. Let's ask some simple questions just to knowledge check theta and see where you're at. Shares trading at 100. If you are long the 95-90 put spread for 50 cents, does theta or time decay help or hurt this position? Hopefully this one's pretty clear. First of all, you're long a spread, which means you paid for it. You bought it for 50 cents. You own the 95 put, which is closer to at the money. So theta is going to hurt this position. It will decay from one day to the next. All else equal, you will see this position suffer. How about this one? Long the 80 strike calls for 20 1/4, or long the 85 strike put for 40 cents. Which one of these two is more affected by time decay? Not trying to be tricky here, but just highlighting that the dollar amount is really not what you're looking for. It's the time value. The 80 strike call with the stock at 100 is in the money by $20. That means there's a quarter of time value here. The 85 strike put has 40 cents of time value. It's also closer to at the money. So the 85 strike put is more affected by time decay. And then the last question, is it possible to buy an option and have positive theta, meaning you bought an option and with each passing day, the value of that option increases and you have theta working in your favor, or at least improving the value of the position from one day to the next? Is that possible? Well, I don't want to be tricky here. Certainly the answer is that it's possible if you can buy an option for less than its intrinsic value, and from one day to the next, the option value is gravitating upwards towards its intrinsic value. So yeah, it is possible. And the next question is, well, when might that happen? Other than some random arbitrage that you likely will never see, there is a circumstance that comes to mind when you might see this, and you might notice that if you're looking at, if any of you track index options, and you look at prices of index options, that's why I say European options tend to be index options. If you're looking at deep in the money, European, most likely index, put options, you may very well see that they're trading for less than their intrinsic value. And very quickly, why would that be? Think about deep in the money puts. They're expensive puts. They cost a lot of money. If it was American style, say equity options, and you bought a 100 delta deep in the money put option, it's going to cost you a lot to have a 100 delta short position. If you got an American style option, you're going to want to exercise that. You'll take on the same risk as the option had, but you will be able to greatly improve your cash position because you won't have all that money tied up in the put option. You will have shorted shares and greatly improved your cash, turned it from a debit to a credit. So you'd want to exercise those deep in the money puts. A European option doesn't afford you that early exercise opportunity. You can only exercise European puts at expiration, which means you're not willing to pay intrinsic for deep in the money put options because you're tying up all of that money from today until expiration date. So you might see that. If you don't trade index options, you may never see it, but if you do look at deep in the money puts on European index options, you might. So it is possible, and it is worthwhile to point that out just from an educational perspective. If you buy an option for less than intrinsic, it may gravitate upwards towards its intrinsic, and it is certainly possible. Let's move on now to Vega, and it's going to be impossible to discuss Vega without also getting into implied volatility and a discussion on what volatility is. First thing I'm going to do is compare historic volatility. What is historic volatility? It's looking backwards at a stock's volatility in the past. It is factual, it is historical, it can be observed, quantified, and you can use historic volatility as a gauge for what the stock price has done prior to today. And there's different levels of historic volatility you can choose to look at, maybe 10-day or 30-day or 90-day, whatever it is that you choose, a certain data set to develop a historic volatility measure looking backwards. Implied volatility looks forward from today until expiration date. And implied volatility is what we're concerned about when we're trading options. It's useful to know what happened in the past. It's very useful to know. But we're more concerned about what's going to happen between today and expiration day. That's how options are priced, using an implied volatility level that will be derived, at least in part, by some type of analysis on what historic volatility has been. Implied volatility, by definition, is the volatility level that justifies an option's price. Back again to the pricing models. If we input stock price, strike price, days to expiration, interest rates, and we input the options price on the other side, we can then back solve for implied volatility. And that's what we mean here. You know the options price, and you back solve and calculate for implied volatility. You can do an analysis of this using a calculator. We've got one on the OIC website where you can put in all of those parameters. You can look at the options chain on your trading platform, determine what the options price is, enter that into the calculator, and back solve. That'll tell you what level of implied volatility is the market using. And then you can either use that info if you have an opinion one way or the other, or just make note of it. Just know what the implied volatility level is. If you buy or sell that option, be aware of what the implied vol level is, and then track it moving forward. It'll, at the very least, help you understand why the price of your option changes over time. If it does, and for those that are beginners to options, oftentimes they're confused. They don't understand, why did my option value change this way? The stock moved in a certain direction, a certain amount of days came out. This isn't the value I'm expecting. If you're tracking implied vol, undoubtedly that will be your answer. So implied vol reflects the underlying stock volatility expected by the marketplace moving forward, but ultimately options are determined by the bid ask from any market participant. Everybody, professionals, individuals, you, me, everyone else, are the ones driving market prices up and down, putting in bids, putting in offers, moving options prices, and as those prices change, the implied volatility is changing right along with it. A common question is to ask, how do I know, if I'm looking at an implied vol level, if it's high or low? How can I tell? And it's a rather complicated analysis. I traded for a small hedge fund at the turn of the century, late 90s, early 2000s, where one of our programs only traded implied vol. That is what we did, was we extracted implied vol levels for all of these stocks we were looking at, hundreds of them, and analyzed the current level of implied volatility compared to the past levels of implied volatility, which I called historic implied volatility, compared those two when current levels were higher than historic levels, not historic volatility of the stock, historic levels of implied volatility itself, that was potentially a sell candidate to sell options, sell straddles, sell strangles. But then further analysis was required. Why is it higher today than historically? Maybe there's a good reason. And then of course on the flip side, if it was lower, it was a buy candidate, but we had to ask and investigate, why is it lower? Will it gravitate up towards its historical mean or not? Or when will that happen? And then we had to trade as best we could from the buy and sell side from there. But ultimately it's rather complex. Comparing current levels of implied to past levels of implied. You have to have some reference point to determine if implied vol is high or low. And then even if it is high or low, there's a deeper question to ask. Is there a reason? Is it really a sell or buy candidate, or is there a good reason why implied vol is where it is today? Might I not want to trade implied vol just because it's not at its historical mean? It's a rather complex analysis. Most professional firms would do it. Some individual investors, savvy, sophisticated investors might do that. But again, at the very least, if you're an individual, track where the implied vol levels are, and when you buy or sell an option, what level you bought or sold, and then keep an eye on that moving forward. Now let's move this towards the Greek. Implied volatility is not a Greek, by the way, but Vega is, and that's where I'm going to move this conversation. Implied volatility has certainly an effect on options prices. As implied volatility increases, the range of potential future stock prices also increases, and that moves call and put prices higher. It's rather intuitive. As implied vol decreases, the potential or the expectation for future stock prices shrinks. The range of potential prices shrinks, and that will move call and put prices lower. As implied vol changes, how much is the option going to change? That's the question. And that is what Vega is trying to answer. Vega is the Greek associated with volatility. It is the option value's sensitivity to implied volatility. Pricing models. If we leave the stock price where it is, we know the strike price. We have a certain days to expiration. We have a certain interest rate. If we change implied volatility, what is that going to do to the options price? That is what Vega is trying to measure. The expected change in the option value with a 1 percentage point change in implied volatility expressed as a dollar amount. I've underlined 1% point change. This is why Vega is such an important factor in options pricing. Oftentimes, implied volatility will change by much more than just 1 percentage point. If you're trying to forecast what might this option be worth in the future, and you're trying to interpret, if the stock moves to this level, what might this call or put be worth that I'm buying or selling here today? A calculator could be your best friend. Go to the calculator, change the stock price, change the days to expiration, and then change implied vol levels. You have to have some reference point. You have to have some level of familiarity with that stock and those implied vol levels, but change those levels and see what kind of an effect does that have on your options prices. And then, as I said, as you're tracking implied vol with your position, you're going to have a better understanding of the importance of implied vol and how your option values change and why they change. Calls and puts both have positive Vega, consistent with what I said before about implied vol. If implied vol goes up, the option value, whether it's call or put, will go up by the Vega amount. Implied vol down, then the option value decreases by the Vega amount. And again, it's each percentage point. If implied vol moves by 5%, multiply Vega by 5, and that's the expected change in your options price. Let's look at an example, and this is centered around earnings, very hypothetical here. I used a calculator to generate these prices, but it is hypothetical. We have a stock trading at 100, days to expiration 13, implied vol 50%, and here's what you've got. The 105 call, just going to focus on the value of 185 prior to earnings. Now I'm going to spend a minute here talking about earnings. Prior to earnings, it is common to witness that option implied volatility levels drift higher. However, that does not necessarily mean that option values are going up. And that's a question I've got. When I've stated that before, someone's raised their hand and said, well, Doesn't this mean I can buy options 2 weeks before earnings and then sell them a day before earnings and capture that raise in implied volatility? And not so fast. Remember that explanation I gave before about out of the money puts not decaying. And mathematically, the only way to make that work is to increase implied vol levels. Oftentimes, that's what happens prior to earnings. We know a big announcement's coming up. There could be huge moves in the stock price. So from one day to the next leading up to earnings, the option decay might not be what Theta is suggesting. Bids are kind of holding steady. Sellers are not so aggressive because they know earnings is upcoming. And when that happens, when Theta isn't occurring as it's predicting, and days are coming out as we lead up to earnings, implied vol has to drift higher. That's the way the models work. You can actually see options prices decrease very slightly, but again, by not as much as Theta suggested. When that happens, implied vol drifts higher. Oftentimes, that's what you see before earnings. That's not to say that option values never go higher before earnings. You certainly could capitalize on that trade. I just want to outline that a raise in implied vol does not mean that the option value itself went higher. So here's what we have prior to earnings. Now, earnings comes out, and the stock goes up by 5%. We had a week come out of these options, and implied vol, which started at 50, is now 30%. That's what we're trying to highlight here. Despite a 5% move in the stock in our favor, which has a positive influence on the call price, because days came out, implied vol got crushed down here by 20%. The value of the call is $1.20. So if we bought this call at 185, we now are sitting on a losing trade after a 5% move in our favor in a week. Now this again does not mean that buying options is a bad idea. Buying options before earnings is a bad idea. The point here is that if we did buy this option for $1.85 with the stock at 100, we would want to know ahead of time that if vol moves to 30%, we need a much bigger move than just 5% to be profitable. If the stock went to 115, this would have been a great trade. So buying the option is not the problem. The fact that the stock didn't move as much as we needed it to move, that's the problem. And that's what I want to highlight here. Even with the 5% move, it did not translate into a profitable position. There's some dynamics there of volatility in Vega prior to and after earnings. Let's do a similar knowledge check here with Vega. 100 strike call. Is Vega greater on a contract expiring in 5, 30, or 90 days? Where will Vega be the greatest? 1% change in implied vol. Which one's going to have the greatest change? It's going to be the longer dated option. Vega, one of the characteristics of Vega is that it is greatest for longer dated options. The longer you have to go to expiration, the more implied volatility has an effect. Here, let's look at a trade, a strategy. Investor puts on an iron condor, just reflecting on what that is. It's selling a call and a put, and then buying a call and a put at wider strike prices. So say stock's at 100, selling the 105 call and the 95 put, and then buying a 110 call and a 90 put. So selling 2 options and then going out wider and buying 2. Does this position have a long or short Vega position? And will an increase in Vega help or hurt the trade? Those 2 questions go together. Short or long position in Vega. Here, while Vega is greatest for longer dated options, it's also greatest for at the money options. And with the iron condor, the 2 options you sell are the ones closer to at the money. You're selling options with greater Vega, which means you have a short Vega position and an increase in volatility. An increase in Vega is going to hurt your position. You have a short volatility position on when you sell options closer to at the money. And the last question here, if the stock drops 15% as a result of unexpected news, say not an earnings announcement, just shocked the industry news, are long or short Vega positions likely to be positively impacted? Which one would you want to have with this stock drop? Well, long positions in Vega. It's common for big stock drops, big drops in the share price, to also be accompanied by increases in volatility levels. That might not necessarily be the case if the stock has dropped because earnings has been released, that big unknown that's been targeted on the calendar. If that is the reason why the stock has dropped, you may not see volatility increase, but you might. If the drop is large enough and the shocking news is large enough, you might see increases in implied volatility even after an earnings announcement. But generally speaking, absent of earnings, stock drops or the market dropping generally coincides with increases in volatility, and long volatility or long Vega positions would be positively impacted. Now, that's quite a bit there on Theta and Vega. I'm not going to spend anywhere near as much time on Rho, but it's important to understand what Rho is. You know, the more knowledge you have, the more confident you are in your trading decision-making ability, the more depth of options knowledge you have, so you're not fear of the unknown. And Rho sort of falls into that category because it's off people's radar. They're not paying attention to it, and it might be a bit of a vague term people don't understand. So let's at least clear that up at the end of this next couple of minutes. At least you'll know what Rho is. And by definition, Rho is the option value's sensitivity to interest, specifically interest rates and the cost of money. When that changes, when the cost of carry changes, what happens to the options price? I've mentioned pricing models over and over again. Stock price, strike price, implied volatility, days to expiration. Interest rates are a major component and a required piece to calculating an option's theoretical value. You have to have an interest rate number that you input, and as that changes, the option value will change. As Rho is expressed in decimal form, and it is how much will the option value change with a 1% point change in the risk-free interest rate. Couple things here. First of all, I underline 1%. As I did with Vega, I said with Vega, 1%, you know, implied vol can change by a whole lot more than 1%. It's the opposite here with Rho. You are very unlikely to ever see a 1% point change in the risk-free rate from one day to the next. Rates change at a fraction of that pace. So despite Rho being a small number, it's also only going to change at a fraction of what that 1% expectation is. And then also the risk-free rate. You might say, well, what are we talking about? What rate are we looking at? And specifically what that is the risk-free rate, the interest rate you can earn on money risk-free between today and the expiration date of the options contract, or the closest you can get there, encompassing that time frame. The LIBOR rate might be, for example, one thing that is used to determine what risk-free rate are we going to use in our pricing models to make this calculation. Again, it's a cash amount. It's considered the least significant of all pricing factors. It's not going to come into play with your day-to-day trading decisions, but it's important to at least understand that you're going to have to input an interest rate number when you're calculating option premium amounts. Rho amounts are generated by the pricing model. Calls are positive, puts are negative. Since we're talking cost of money here with Rho, the larger dollar amounts have a greater effect. Interest rate changes on in-the-money calls and puts, the higher dollar cost options are going to be largest, and the longest dated options are going to have a greater effect. The more expensive options, these are interest rates, it's cost of money, the more expensive options, in the money and days till expiration. And maybe one of the key takeaways here with Rho is just simply the relationship. As rates increase, call prices increase, puts decrease. As rates decrease, you have the opposite, calls go down, puts go up. I think the easiest way to remember this is to think that options are priced based off of the future value of today's dollar amount, or the present value. If the stock is trading at $100 today, and remember, options are not going to be biased towards the upside or downside. If you have a $100 value today, what is $100 worth a year from now? If interest rates are 1%, then it's worth 101. If interest rates go up, then a year from now, let's say interest rates move from 1% to 2%, $100 today is worth $102 in a year. As rates go up, that future value goes up, Now it might be more clear to see as the future value goes up, call prices are going to increase, put prices go down. And as interest rates decrease and the future value of the stock decreases, all of a sudden now you have calls being priced off of lower values and decrease while puts go up as rates decrease. I think that's the easiest way to understand that relationship. You could also interpret it a different way. The value of holding cash in your account is worth the risk-free rate, whatever you can earn on that money. If rates go up, holding cash in your account is a better idea. You want more of it. So calls are more valuable because calls are a cost-effective way to purchase or get exposure to stock price movements. You don't have to pay for shares. Buy calls instead. If interest rates are higher, that's more valuable. Puts are the opposite. You'd rather sell stock or have cash in your account earning a higher rate rather than buying put options. So that's another way to look at that relationship. But that's about all I think you need to know about Rho, the definition, what is the risk-free rate that you're looking at, and then this relationship, rates increasing and rates decreasing. We have a lot more on our website at OIC about the Greeks, and we do presentations like this every month, not necessarily this one, but we have all sorts of different topics coming up. We're going to be talking about parity next month. We'll be talking about implied volatility as well. We're going to have a state of the industry year to date in September. So all sorts of different things. You can find a list of our events on our website, archives of podcast videos and webinars. You can get those on our YouTube channel as well. A lot of different sessions we've done just like this one on the OIC YouTube channel. And take advantage of this team. I used to manage this desk here. Former traders and brokers, they're all very well versed in the options product. They're a free service. Everything OIC does is free of charge. We're just an industry resource, nonprofit. So you can send options related questions to these guys, options@theocc.com, and they will do the best to help you out. It looks like there were a few questions that popped through, but they were very nicely answered by Gina and team. So nice job on that. And I'm going to leave this contact information about OIC up on the board as I bring in Gina to have a few final comments and close things up.
Thank you, Ed. We actually did get one question in the chat room that I'd like to pose to you, if you don't mind.
Sure.
So can you show an example on how to use the Greeks when rolling out an in-the-money option? And if anyone has any questions right now, please feel free to put them in the Q&A box, and Ed will be happy to answer them.
So how do you use the Greeks when rolling out an in-the-money option? I suppose some of that would depend on just how in the money this option is. I'm going to just specify, say you're looking at a call option. The most common occurrence that I come across is when you are long an options contract, it goes in the money, and you want to continue this trade. You don't want to exit. You're not done with it. So you want to roll it, but you want to roll an in-the-money option to an in-the-money option. And that's the most common occurrence. Say you have a call option. You own it. Stock goes in your favor. Now it's a 90 delta. And you want to roll it out because it's approaching expiration. You want to continue this trade. You don't want to buy shares. You want to sell your in-the-money call that's been working out for you and buy a longer dated one. Delta is really the Greek that would come to play here because as you're rolling out, and this would be the same analysis for puts, as you're rolling your call, you're selling your 90 delta call, and then you're buying a longer dated call to continue the long delta position. If you went to a 90 delta call, well, a couple things. You're going to likely incur a debit to do that. That'll increase your total cost of entry on the position, and you have a lot more exposure there. If the stock does drop and move the other way, then you're exposed to a greater loss than you initially had when you opened the original position. So I think delta comes into play when you're doing this, and you might then target, say, I'm going to sell a 90 delta call, but I'm going to look at, say, a 70 delta call or a 65 delta call as the long-term option I'm rolling out to. You know you're going to have to pay a little more time value there, so that's going to work against you. However, if you sell a 90 delta near term and you buy a 60 delta, say, long term, you're likely going to get a credit to do that You may be able to book some profits off your original trade, or maybe get the trade down to zero cost. You continue your bullish thesis, and if the market does crash and move against you, you're not going to lose as much because you didn't pay for another 90 delta call. So what I really just described there was using delta as a guide to roll out and up. And that's really the direction I took the question. Roll out and up when you have a profitable in-the-money option. Again, same way you would do with puts, just outlined it with calls, and I think delta is the way to go. When you're dealing with in-the-money options and you're dealing with two of them, the other Greeks, they're really, well, the Greeks in general, they're going to offset each other. Your Vegas will be relatively, I don't want to say equal, but they'll be comparable. Your Theta will be comparable. Those out of the money or deep in the money options have Thetas and Vegas that really start to shrink together and become more comparable to one another. So I think delta is what you'd be looking at there when you're rolling out.
Okay, thank you, Ed. It looks like that looks like all the questions that we have. And we did have a few questions in the chat room about the webinar recording. If you go to eOption.com, we do have a tab resources, and we have webinars and videos there. You will see a recording up in the next few days, as well as we will also email that to you as a courtesy for attending our webinar today. And a few housekeeping items. We do, if you want to get your calendars out, we do have a few more upcoming webinars. As Ed mentioned, if you want to hear Ed again, he is giving part 2 of this series on Tuesday, August 25th at 1 p.m. Central Time. And it's all Greek to me, or understanding the Greeks, delta and gamma. So a few more concepts on the Greeks. And I did speak to a few option traders at our firm, including our founder, and he said that he uses delta. That's the most common Greek that he uses, and Ed was talking about it as well in the Q&A section. So if you are interested in learning more about delta, we hope you can join us in about a month on Tuesday, August 25th. The next webinar we have is in actually about 2 weeks. It's Wednesday, July 29th. And this one is by an expert trader. And it's, if you think you're priced out of the market, then think about options. And we'll be looking at Netflix and Amazon and some of the high flying stocks that you might be priced out of, but may still want to participate in using options. And again, that's Wednesday, July 29th at 1 p.m. Central Time. If you want to find out more about our webinars, I hope you'll like us on Facebook. You'll get advance notice on Facebook, as well as investing tips. And we will also be sending out an email as well, so you can sign up for these. You can also go to our website at eOption.com. Again, under resources, we do have the webinar tab, and you'll see the sign up pages there. Also, just a few housekeeping items. We do, if you enjoyed the webinar today, we do have lots of education for you on our website. We have past webinars. We also have instructional videos. And the Option Industry Council, we have high regard for them, and we do have a whole page on our website of strategies you can use. So if you just click on the link for the strategy, such as an iron condor, it'll explain to you how to use the strategy, a chart, and so forth. And so it gives you a lot of good ideas. We also have a free option trading guidebook if you go to eOption.com. And we also have instructional videos on how to use our platform, as well as different option trading techniques. And so you'll find our eOption.com website is a tremendous resource. We do also have a YouTube channel with all of our videos on there as well. And again, thank you to everyone for attending the webinar today. And thank you, Ed, for your presentation. We really appreciate everyone taking the time to join us. And again, for those of you who aren't current customers of eOption, we do offer one of the lowest rates in the industry for option traders. Again, as our name is eOption, we do cater to option traders. We're kind of like a boutique option trading firm. And our stock and ETF trades are just zero commission, and our options are just 10 cents a contract plus $1.99 per trade. So it is one of the lowest in the industry. So we hope that you will check out our website, and you can feel free to contact us at any time with questions. So again, thank you everyone for attending. We greatly appreciate it, and we look forward to seeing you at some of these upcoming webinars in the next few weeks. Thank you.